Insurance is always that hidden force that comes to you in terms of helping you whenever you need it. Insurance is the most important tool that is used to transfer the financial burden of certain risks from the individual to the insurance company. The life is covered with all kind of risks, and that insurance company says that in case the person passes away, good morning and welcome to the first session in Unit 2, third semester Insurance Management for BCom, where we are going to speak about management of risk by individuals. Probably the term insurance itself has got a lot of risk inside it. Moment we talk about insurance, people are not really happy about it because they always think that insurance is a backup plan and it is not needed in our regular walk of life. But in the modern times, insurance has become a subject matter of importance. Why? Because every day our life is surrounded by risk and we need to understand how to overcome this risk. So when we talk about risk management for individuals, this is a process of identifying, evaluating, mitigating the personal risk that can lead to financial loss. Followed by, insurance is the most important tool that is used to transfer the financial burden of certain risks from the individual to the insurance company. Now, the most common risk that an individual can think about is health. Anything happens to health, it is very, very difficult to recover. And there's a huge financial cost added to it. So how do I recover that financial cost? I need an insurance. So the transfer of financial cost to a third party who can take it on behalf of me and drive it forward is where risk management comes into picture. Moving forward, we're going to talk about the key techniques for managing, starting with the avoidance strategy. Now, this is the most easiest and the best strategy, I would like to say. In the Arthashastra book, and also when you talk about the art of war, it is very, very clearly written where they say the biggest war that is ever won is the one which you have never fought, which means to say avoid risk. War is also a risk. Similarly, health problems are also a risk. So avoid health problem. Avoidance is the biggest thing that you need to understand. Why? Because it means eliminating an hazard, ceasing an activity that could cause a loss. Now, where does this come into picture? Why is this becoming a very, very important for us? Sometimes you know that you can avoid certain things to keep yourself healthy. So why don't we just practice those methodology so that we can avoid health problems coming to us? So by avoiding certain things, you can eliminate that activity from coming towards you. So avoidance is one of the key techniques of managing risk. Followed by reduction. Involves implementing measures to decrease the frequency or severity of the potential loss. Let's look at the example, a home security system that is going to detect about the theft practice. Now, let's understand this method very, very clearly. Now, you know that beyond a point, risk cannot be controlled. Now, you cannot try to control the nature, you cannot try to control your fate, or you cannot try to control things which are beyond your perimeters of thought. Now, what happens here is that we can reduce it. So we can bring in a system that can detect the process, that can give you a signal early hand and tell you this is going to happen. So why don't you prevent it? So reduction is bringing down the risk, minimizing that risk altogether. So that's why reduction becomes a very, very important process. Retention. Retention is an acceptance of financial loss when it occurs. So individuals retain that financial loss so that, they believe that, okay, further we should not get into it. For example, a highly deductible health insurance plan where you agree to pay more out of the pocket so that you can go for smaller medical expenses. Now, this is quite common. Now, people ask this question, how much should I pay to secure my life, to insure my life? I mean, there is no value to it if I have to give you the answer. Your life is priceless. You cannot fix a target. You cannot fix a price to your health. So what happens here is that the insurance company cannot go on this philosophy. So what do they try to make you understand is the higher the amount of coverage you take, it is easier for you to manage the medical expenses in case something happens to you. So what happens here is a retention. Yes, I'm ready to take that financial burden on me right now. But later, something happens to me, the medical expenses can be completely borne by the company. I can completely try to reduce on my medical expenses. So the retention of understanding that yes, I will take the risk right now. I will bear the loss right now. And then go for a further mitigation at a later stage is where retention strategy comes into picture. Followed by which, sharing. In insurance, risk sharing or risk pooling involves distributing the financial burden among a group of people. So as we talk about insurance plan that is given by the employer, the corporate insurance plan or the group, all the organizations in India as well as abroad always pay a huge amount of money to some insurance company to take care of their employees. This is where risk sharing comes. Now, I'm not going to burden you by just asking you to take a personal insurance, but rather the company takes an initiative saying that, sir, please take care of this insurance so that it will help you for some benefit. So the company insurance is a kind of risk sharing or a risk pooling method where the risk is equally divided among those hundreds and thousands of employees. Now, transfer. This is the most common use in insurance. The transfer involves the financial consequences of specific risk to be insured by paying premiums. So purchasing an insurance policy so that you can mitigate the risk, quite common. When you build a house or when you buy a car, you always want that house and car to be protected because it's your hard-earned money, that's your dream, that's your passion, and you believe that your dream should never get shattered. So you always want somebody who can protect it, who can give an overlook to it. So in that case, what you do is that you buy an insurance policy to protect your assets. That's exactly where the transfer of risk comes into picture. You are paying a premium to the insurance companies so that they would be able to take care of that property or that asset in case of emergency, in case of danger, or anything that untoward happens to it. That's exactly what we mean by saying the transfer of risk. Moving further, we're going to talk about the risk factors when it comes in terms of life risk, which is very, very important. Why? Because it protects a family's financial factor. And the most unfortunate thing that you can ever talk about in anybody's life is death. Now, we all know that death is permanent. You're not going to escape from it, but nobody wants that death to knock your doors early. So always you want to see that in case if something happens to a person and the person ceases to exist in the life, then what happens? The family should not go unprotected. The family should have enough backup so that their regular walk of life is not disturbed. And that's where we bring in the life insurance into picture. The life is covered with all kind of risk, and that insurance company says that in case the person passes away, the company passes on the benefits to the family. So somewhere that income gap can be managed. Followed by which the health risk, which is always due to the illness and injury factors that we are speaking. And of late in India, we know that there are numerous kinds of diseases which include your mental illness to that of your physical illness, which comes into picture. Many of us might suffer from diabetes, from blood pressure, or when we are talking about some kind of ortho problems, or we are talking about some kind of retina problem, or we might be suffering through mental illness. These are certain things which are unavoidable in the modern days. But is there a cure for it? We do not know about it, but we definitely know that there is an insurance for it which will help you to back up your cost. So that's where the health risk gets covered by the insurance policies. Followed by which the property risk and auto insurance, as we have already talked about, personal properties and autos are definitely covered under this. And then we talking about the liability because of the legal and financial risk factors that are arising because of the injury that can be caused. So this is a typical kind of standard homeowner's auto insurance policy. The umbrella liability, which provides an additional layer of protection. At the end of the day, if you start asking me this question, do all these things start fulfilling the needs of the man? Definitely not. Insurance is only a standby procedure. Insurance is not the final solution. But nevertheless, when you need somebody to console you, when you need a shoulder to cry, when you need somebody who can give you that strength, the stamina, the motivation, and the power to come back in life, you always need to rely back on insurance. So insurance is always that hidden force that comes to you in terms of helping you whenever you need it. Insurers manages risk through a comprehensive process called as the ERM, or the Enterprise Risk Management, which involves identifying, assessing, and responding to all potential risks faced by the company. Unlike traditional risk management, this is specific to the company, and it's a very, very holistic firm-wide strategy. Now, why is this very, very important for all of us to study? It's quite important because let me tell you how this insurance risk is such an important factor here. Now, there are many kinds of companies in this world, starting from a chemical company, a banking company, a shipping company, logistics company, or IT services company, securities company. You can have so many different types of companies that have been there. The nature of business differs from one to another, which means the kind of business, the transaction, the risk involved, and the mitigations are entirely different. So one needs to be very, very careful in understanding this procedure. Company-wise, enterprise-wise, there needs to be a strategy to manage the risk. So when we start getting into it, the first thing is underwriting risk, and then we start talking about the risk profiling. What is an underwriting risk? An underwriting risk is the core business risk for the insurers. It involves correctly assessing, pricing, managing. The risk profiling, where you collect and analyze the vast amount of data and segment. Then we start talking about the predictive modeling also, where actuaries use predictive models based on historical data. So let us first try to understand each one of this. Underwriting means the first thing is that you're going to assess something, you're going to value it, you're going to see how much pricing and what kind of strategy you need to put in. Now, risk profiling means you start with the demographic, financial, historical claims. Is it a high risk or a low risk? All those profile part would be there. Predictive is that based on the historical data, you will predict in future what can happen. Followed by which the investment risk, the risk of premiums they collect, asset liability management, which is a very, very important part of finance today and insurance, because you need to know at what level are they generating sufficient income or returns or cash flow altogether. Suppose the liability is more than the asset value. That means the companies will have a difficulty when these people file a bankruptcy or when they go for an insurance claim. So it's very important to check the asset liability management. Followed by which the portfolio diversification. Now, what normally happens is that the insurers will actually diversify their portfolios by putting it in equities, bonds, real estate to minimize the impact of single investment. Now, this is very, very, very critical for us to understand. We don't put all the eggs in one basket. We try to minimize and mitigate the risk by putting it in different asset class. That's exactly what insurance companies do. Why? Because you can need to put it across in equities, you need to put it across in real estate or in bonds or any other place. That goes on just because you want to mitigate the risk and take it forward. Now, hedging is a very, very complex financial instrument when you're trying to use with your derivatives, and it might be used to hedge against the interest rate fluctuations or higher financial market risk. Now, when you look into the US market currently, you might have been experiencing for the past 1 week, there has been a government shutdown, and then the Fed rates have been playing a very good major impact there. Suddenly people are feeling that the US government might crash. There might be a higher yield in terms of interest rate, and you might also see that the dollar is at risk. So when you come to these kind of scenario, you need to know about the concept of hedging, which will actually try to reduce those fluctuations and help you to overcome the financial market crisis. Followed by which the operational risk and the internal controls, these are very much needed, because when you start seeing these kind of risk inanimate, they start just coming out from the internal factors altogether. Now, sometimes what will happen is that there is a human error factor that you need to take care, system failures and fraud that start coming into picture. So insurance companies are equally aware about this factor, that operationally there are n number of challenges that they need to assess before giving an insurance claim of an organization. followed by which the internal controls and procedures, which talk about the SOPs or standard operating procedure, for which you can understand the potential human error process and breakdowns. Internally, every insurance organization will have their own operating methods and standards where they will tell what are all the factors that we need to look in, check in clearly so that we can avoid human errors and the factors here. Followed by which the business continuity plan, cybersecurity. I think cybersecurity is becoming a very, very hot topic these days because everybody is talking about data breach. Everybody is talking about somewhere a hacking happening or the data getting completely stolen or some kind of ransomware, malware attack and all those things coming into picture. And not to forget about our BCP, which means to say the business continuity plan. In case if there is going to be a disruption, then what happens to the business? You cannot just go back and tell your stakeholders and your investors that we're just shutting down and the business got completely exited. No, that's not what they want to listen. So you need to have a backup plan which will tell you in case of disruption, how do you take forward the business to the next level? So that is where we bring in the concept of business continuity planning. That will take care of all the natural disaster, cyber attacks, or any kind of disruption that happens on the company so that the business keeps on moving further. Now, regulatory and compliance risk, this is very, very important for us. Why? Because now regulations under which you work. In India, we have the Insurance Regulatory Development Authority, the IRDA. Now, the Insurance Regulatory Development Authority is the main factor. It's the key organization that regulates the compliance factors here. They tell how you need to operate, what are all the conditions under which you can assure the people about insurance, what kind of compliance we need to know, the penalties, the reputational damage altogether, the regulatory monitoring that comes into picture, and adapt to the internal comfort. Now, the ORSA process, the Owner Risk and Solvency Assessment, is an internal process that is given by the Regulations Committee to assess the insurer risk and the capital relativity to its risk factor altogether. So all these things are very, very important for us to understand because these are not quite simple. These are certain things through which we need to understand how insurance is being managed. The risk transfer and sharing factors that always comes into picture, which is very important for us, reinsurance and securitization, which is also important, why we need to look into it. Now, sometimes, let's understand this, even the insurance company need a backup. What happens if the insurance company itself collapses? What happens if the insurance company itself comes into an attack? So you need somebody who can back up that back, completely taking back into position. That's where a reinsurance comes into picture. Now that's a very, very big and a complex business. And you also transfer some of the risk there. Securitization, when we are talking about transfer of risk to the capital markets by issuing those instruments. Followed by which the risk retention and the deductibles. So what we do here is that we retain a portion of risk under which we write, which is strategic choice that is influenced by the strength and risk appetite. Then we have certain deductibles where we set policies for the coverage limits which require for the policyholders to retain. Normally, insurance company do not just blindly give away 100% of the claim. So they retain some part of your insurance policy because that's a part of your deductibles and limits. And the capital reserves, they maintain a very, very active capital reserve because in any case, they should be able to absorb the fluctuations. Followed by which the core risk, we also talk about risk reduction and control, diversification of products, the claims management, because these are things that are on a regular basis for an insurance company. At any given point of time, you might be able to see that there are certain ways where you would see that I need to diversify my range of products. It might be a unit-linked plan, it might be a government plan, it might be a plain insurance, or it might have a complex instruments mixed together. What kind of claims I need to take care of, how I need to settle those claims, what should be the time period for it. All those things are being managed in your core risk management portfolio. Now, With this, we come to the end of this session. I hope and believe that all the factors that I have spoken here would be of a great help to you in terms of theory as well as in the practical walk of life. In the next session, we're going to talk about the functions, the history, uncertainty and risk, and some principles of insurance. So until then, stay tuned, stay blessed, and thank you once again for joining me today on this wonderful session.